Do you consider yourself a savvy investor? Let's run through the list in today's video of the ideal order of the investing for high income earners. Now, when it comes to high income earners, we're looking at 100,000 plus. And of course, the big thing with this is how much money you can keep out of the paycheck that you're getting. I've seen a lot of people that are earning $100,000 a year and they are living paycheck to paycheck. It is very crucial to understand the methodology behind the ideal order when it comes to investing. And of course, this is the best way and the fastest way to build up that net worth. Starting with number one, which is the cash or the emergency fund. Maintaining a liquid cash reserve really gives you a couple different things. And of course, looking for unplanned expenses, you'll have the ability to cover those without having to borrow, keeping that 3 to 6 months on a reserve. Now, in addition, when you start looking at the risk tolerance, having cash on the sidelines is also going to give you the ability to invest it when and if there is a downturn on the market, or if there is a good opportunity that pops up, you're going to have the money in that emergency fund on that cash on the side so you can go ahead and invest. Second one we look at is the 401k employer match. When you think about your 401k plan, when you think about your employer match, you are essentially getting free money. It is 100% guaranteed return when they're giving you a match. Now, the average that we've seen is 5%. So if you're putting in 5% and they're putting in 5%, you are automatically doubling your money or getting that 100% match. And of course, you want to make sure that you're getting this in the entirety. If your company is giving 7%, 10%, whatever it is, you want to take advantage because this is part of the compensation package when it comes to employment, making sure that you are making the most of those company matches. Now, if you do work for a publicly traded company, chances are they will put you in or you can be access to an employee stock purchase plan. Now, this is an ESPP plan is what it is called. Now, when I did work at a financial institution, I had the ability to contribute to a stock purchase plan, which made a huge difference when it comes to net worth. Participating in this, and of course, you get a discount. So when you're buying stock of a particular company that you do work for, usually they get about a 15% discount, which is exactly what I did. I was actually, again, working at a financial institution that was a larger institution, publicly traded. We got 15% off, which means every time that I bought stock, they give me a 15% discount. We even had the ability to sell the stock once it was purchased. There wasn't a holding period. There wasn't a cool down period. So you could literally turn this stock over pretty quick at your 15% discount and make a pretty good amount of money. Now, of course, taxes were involved with that, but you are still getting that 15% discount. Now, looking at number four, high interest debt. When it comes to credit cards, when it comes to student loans, when it comes to auto loans, avoid at all costs paying interest on anything. Every single dollar that you're giving away in interest is a dollar that you cannot put elsewhere. That is money you cannot put into investment accounts. That is not money that you can build up that net worth. Making sure, again, when you start looking at credit cards and they're about 25%, this is one of the absolute biggest detrimental things that I see. If people are holding an absorbent amount of credit card debt, $5, $10, $15, $20,000, that credit card debt every single month is going to be eating up your ability to invest, and also being able to pay that down is going to be a game changer for your credit. Student loans, the exact same. When you start getting out of school, when you start getting into your career, into your field of study, into a real job, a grown-up job, a career, whatever you want to call it, make sure that you're knocking out those student loans. We don't want these to be around for 10, 20, 30 years, depending where you are. Getting these knocked out is, again, going to not charge you interest. So you're going to have the ability to keep that interest payment or that interest money, meaning that, again, you can use it somewhere else. Looking at number five now, instead of just getting the company match, we are looking at maxing out your 401k. That is right. When you start looking at maxing out your 401k, there are really two different ways to do this, and talking to a tax advisor in this methodology works well. If you're getting a tax-deferred growth with really putting money into the 401k, you could go for a traditional 401k. My preference, regardless of how much you earn, putting it into a Roth 401k if your company does provide a Roth 401k. And of course, you don't get the tax advantage, but if you're looking at 20, 30, 40 years down the road to retirement, you also don't accumulate that tax bill on any of the growth that you're getting. So as you're seeing the snowball roll, as you're getting that compounding interest within your investment accounts in that Roth account, you do not have to pay taxes when you take the money out, which again, mathematically is an absolute game changer when you do get to that point. And of course, guys, a side hustle like this wouldn't be it without you. So if you like the content that I'm putting out there, please subscribe to the channel. Let me know in the comments what you guys think, and we'll get into number 6. This is maxing out the HSA. Now, again, when you start looking at the pecking order, if you're in a high deductible healthcare plan, it is a triple tax advantage, meaning that your tax deduction comes from your contributions. It grows absolutely tax free. And if it is qualified medical expenses, you do not pay taxes on it either. This is one of the absolute biggest tax advantage accounts that we see. And of course, maxing out that HSA has really an untold effect that people don't realize is when you get to the point of retirement. So when you actually go on a government program and you're in retirement, you don't have the ability to contribute to an HSA account because you are no longer under the high deductible healthcare plan with Medicaid, Medicare, which means if you can stockpile a lot of money in the health savings account, and I know traditionally they say around $70,000, if you could stack away $70,000, chances are the first 10 or 15 years of retirement, if you retire at 65, chances are by the time you're 80, this HSA account will have covered your medical expenses 100% in your entirety, meaning that you're not taking money out of pensions, you're not taking out of 401ks, you're not taking money out of IRAs. All of the money that you're using for medical expenses are coming from this HSA account, which again, when you get to a fixed income like Social Security, it is an absolute game changer not having to take money out of there. And if you think, even if you get a health savings account much higher than that, overall with the growth factor in there, if you could actually pay for medical expenses and the growth factor cover a lot of the costs that you're taking out, would again be an absolute game changer for the rest of your life. Now, when we look at number 7, we are talking about the backdoor Roth IRA. Very different than a traditional IRA because, of course, IRAs have contribution limits, which means if you're a high income earner and you're exceeding the maximum income limits for those IRA accounts, that backdoor Roth will actually give you the ability to sock money away in a Roth IRA. Tax-free growth, which of course is going to be huge. The unfortunate penalty for this is you do have to pay taxes up front, but you make a contribution and then it slides into that backdoor Roth IRA to make sure again that it is going to be growing tax-free. Now, number 8, and this is one that I haven't heard of, is a mega backdoor Roth. So if your 401k plan allows after-tax contributions and you've maxed out traditional contributions, you can do this, which again, tax advisor guys, in any of these, because they are very, very specific strategies that have to be executed within a particular time frame. Now, number 9 is one that I love, the 529 education savings plans. This, of course, is money you're putting in there. You get a tax deduction. And then, of course, if the money grows and the withdrawals, as long as they are qualified expenses when it comes to school, they are completely tax-free. So when you look at big picture, you are taxing in essentially you're building up so many different avenues when it comes to net wealth. You have money in a Roth, you have money in a 401k, you have money in your HSA, you have money in the 529 plans. There are so many different places if you're looking to really invest. And again, systematically going through these. Now, number 10 is the taxable brokerage account. This is where we're at. We have gotten to the point where we're doing everything else. We got the 401ks max. We got the HSAs max. We got the 529 plan going well for our children. And now we're looking at the taxable brokerage account, which of course, I do have everything that we have in ETFs and index funds. Absolutely putting money in there is vital. With the taxable brokerage account, even if you retire early, for instance, we're looking at 50 years of age. So if you retire at 50, then of course, Roth withdrawals 59 and a half. You can't take it before you're penalized. But even looking at Social Security kicking in at 65, there's going to be a multitude of years that we're going to have to cover expenses, which are going to come from the taxable brokerage account for the money that we do need. Now, number 11, we get into real estate. So when you start looking at REITs, when you start looking at real estate, there's really, again, 2 ways that you can do this. Number 1, owning the physical real estate. So actually having rental properties, creating rental income, VRBO, whatever it may be, you can actually own the physical place and have, of course, those physical properties that you're collecting rent from and you're maintaining, and you are building equity in there. The second one is, of course, the REITs, the Real Estate Investment Trust. This, of course, is not directly owning the property, but this is owning what the property is invested in. Now, we've looked at a couple like the Realty Income, which the ticker symbol on that, I believe, is O. but this is a real estate investment trust that invests in some of the largest companies in the world with industrial. They do have commercial, they do have a lot of residential, which we see in Fundrise. Fundrise actually had a lot of residential. And then the final one we look at is low interest debt. If you're aligning with really the preference of peace, not having any debt, being 100% debt free, which is exactly what we're doing here, guys. If you see my little poster right back here, it is the debt free journey, paying off everything, including the home mortgage. Now, when you look at this list of 12 things in their entirety, you will notice the very last one on here is paying off your mortgage. Now, for a majority of individuals, including myself, we are sitting at 2.5% on a 30-year mortgage. The rate is so incredibly low that I cannot overlook any of the tax benefits that I get from everything else, including the growth factor. When I start looking at my portfolio, even my 401k this year is at about 14%. There's no reason to go in there and race to pay off my 2.5% mortgage when I'm earning 14% in that 401k plan with regular contributions. And of course, the growth factor in there, the dividend factor, it does make an absolute game changer. All right, guys, so that is going to do it for today's video. The ideal order of investing, definitely a big priority that you have to look at. All right, guys, again, that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.